Welcome back to Turning Hard Times into Good Times. Thank you so much, Michael, for being with us.
Oh, that's fine.
Coming back here, the second segment here.
Sure. Okay.
All right. We were you've come up with this plate tectonic shift that you saw happening, and I being one that's always looking at geology, looking at companies and their geological prospects, and realizing how slow the plates are to move, and it takes a long time for things to really become noticed. You might have a quarter of an inch a year or so the major plates are moving. And sometimes, people are very impatient about markets. They want to make money right away. They want things to happen right away. Mm-hmm. And you sit back and look at it in a scientific way. You look at your numbers, you look at what's going on with your momentum work and so forth, and you could see that these major plates were starting to come to the point where there was going to be some major movement, where there were the levels of, or some point where the stress could not be taken anymore, and we're going to start to see some major shifts. And you turn pretty bearish, at least longer-term bearish on bonds and equities, very bullish on precious metals, on currencies, bearish on the dollar, and also bullish on commodities and precious metals. And lo and behold, everything's pretty well working out. Now, nothing is going to happen instantly with all those plates. In other words, we're not going to see everything go at the same way. Just as in nature, you won't see the major plates on the earth all shake and move at the same time. So give us an update as to where we are. We've seen the precious metals make a big move in 2016. Yeah. We've seen oil and the commodities. On the commodity sector, you're very bullish on it. Talk to us a little bit about commodities and where you see the most movement in 2017.
The move last year was the Bloomberg Commodity Index is a good model of the commodity category. I think the way it's fragmented into the food commodities and the oil and precious metals, it's distributed nicely. It's not lumped heavily with energy, for example. Yeah. So it's a good balance. Okay, so I use it as my metric. It used to be the Dow Jones UBS Commodity Index, and Bloomberg bought it back in 2005, I think. Anyway, it broke out last year, in our opinion, on annual momentum at a price of about 84. It shot up recently to about 88 or so, no big deal. But from year-to-year close is very interesting. Last year, S&P was up 9-point-something. Bloomberg Commodity Index is up 11-point-something. And it did that without the assistance. In fact, with negative action by the meats, downside, and grains laying on their back. As too big, the food commodities basically did not participate, with the exception of sugar, in upside. Last year was entirely almost oil, precious metals, and sugar. And so the big chunk of the commodity category, the stuff we eat, did not participate. But it was building structure, in our opinion, to a basing structure on momentum, and you can even see it on price to some extent, that says, okay, we're about to join in. So I think this coming year, they're going to rotate, just like in the stock market. There are categories to be in and worse categories to be in, either go up less or down more and so forth. Well, in commodities this year, we expect grains and the food commodities in general to have the best percent gain. The likelihood is that. And I think oil will have it may still have one more spurt in it, get you up close to 60 or the upper 50s, and our high so far has been just above 55. But I think it's near the end of its first major up leg from its bear market low, which was at, just above $25. And then I think oil is not going to be the leader anymore in the commodity sector, and probably, ratchet its way back down to some extent while these other commodities take over. And I think that will give the further boost to the Bloomberg Commodity Index and so forth. Gold to some extent is apart from this. It's really money. And so while we think of it as commodity, it's really monetary. So the issue there is, again, the dollar index that we talked about breaking 99, which it's come very close to last week. But if I can get it to break that, then at that point I think the dollar will become a factor. Last year it was not, because it was so dormant. Had one of the most dormant years in the euro and the dollar we've had in many years in terms of lack of volatility and lack of trend. But the bond markets, I think, are a trigger for stocks, negative. Yields are turning up. We know that. Bond prices are coming down. We're bearish on UST bonds and so forth. But we did a study last week on the European bond markets, specifically not the price, but the yield charts of Italy, Spain, France, and Germany. And they're spiking up. But you got to remember, one of the charts was ludicrous to me. Back in 2011, if you recall the European debt crisis, we dropped hard in August, September of 2011, and the S&P and the DAX index did too. But it was sparked by Greece. Now we're facing a debt problem from Italy, because Italy is the largest, its government debt to GDP ratio is the worst in the world, I think, next to Japan, and certainly the worst in Europe, and it's very sizable. Well, the ECB, in their wisdom, drove the yields of the Spanish 10-year bond and the Italian from something like 7% yields back in 2011 down to 1% or less.
Yeah.
In that period of time. Now, that didn't happen because everything got better over there. It was an artificial pricing invasion by the ECB to bid those bonds up in price, down in yield, such that the Spanish and the Italian yields were lower than U.S. 10-year T-note yields, which, of course, is ludicrous. I mean, we have our debt problems, but it doesn't compare. So, anyway, those markets are turning up. Yields are turning up, and they're breaking out. And I think you've got to watch Italian bonds in particular, and even French bonds have broken through in momentum in terms of yield. So I think the yield problem in Europe, meaning the wresting away from the ECB their control over the debt of the interest rate situation, is going to be a spark. And it's not Greece anymore, it's now Italy, to some extent Spain and France. So I would be watching those bonds over there more so than I'd be watching the DAX index or the CAC index. As far as European stock prices, I'd be looking at their yield prices, because that's where I think the earthquake will come that will shake loose the equity markets. Right now, we've rationalized it, stock bulls. They said, rates are going up a bit because the economy is getting stronger. Right. Well, it's also repricing itself because it had been artificially priced by central banks, the interest rate markets, and they're losing control over that pricing. And I don't care about the overnight rates of the Federal Reserve. That's irrelevant. I'm talking about 30-year, 10-year, that type of stuff. Yeah. Those rates are rising, and not just here, but especially in Europe, and they can't afford to. And it indicates to me that the control, the influence that's been exerted by the ECB, the Bank of Japan, and the Fed from 2011 to 2016, let's say, that game's over. And the point at which the public, the investor, realizes that could be a stark moment and impact stock prices at that time.
So let me understand, if we start to get really, rates start to really rise dramatically in Europe, that would be bullish for the euro, possibly?
Well, yeah, but it is also, the euro was also artificially priced. Remember, the ECB wanted not only rates down over there, they wanted the euro down because they thought that helps trade and all that nonsense. Right. A great argument, but it doesn't hold water. But so when you have artificial pricing, it's like pushing a beach ball underwater. It didn't go underwater by itself. You pushed it under. And as soon as your hands lose control over it, it comes up. It doesn't just come up to the water level. It often overshoots, if you know what I mean. Yep. So when you have an artificially priced market, whether stocks overly priced on the upside, but because of central bank policy and intention, which Bernanke even stated was his intention, and you have debt markets, yields priced low, but artificially so, not where the reality would be. And those things come undone. It's like a snapping situation. So the tectonic plate, instead of moving slowly, it moves like an earthquake. You suddenly get a whoosh effect. And my opinion is stocks aren't going to drive themselves down, even though they're deserving of it, especially Western developed nation stocks. It's going to be an effect of yields. That will be the domino that topples into the stock markets. Not emerging markets, but the developed markets, Japan, Europe, and here. And so I'd be more focused on what Italian bonds do right now than I think about anything else.
Interesting. Very interesting. Well, Michael, getting back to the commodity sector, I have to thank you. You put out a missive, and most of the people who hear you talk about gold, the dollar, maybe T-bonds, maybe the S&P now and then. But people should know that your service involves an awful lot more than that. We talk about those markets because those are the ones that we're most focused on this show. But you also put out a piece this last week on livestock, I think on
Live cattle.
Yeah, live cattle. Thank you. And I went out and looked for an ETF in live cattle, and I found cow, COW, and it's performing very, very nicely for me this week. And I
the cattle market was a big negative last year. It was collapsing in price. It started what we called a bear trend back then, and I think it was the opening of 2015 or 16. I forget which year it was, but it was $160, and they drove it down to well into the 90s before it was over with. But cattle is now, as far as we're concerned, bottomed, and will contribute, therefore, to the commodity upsurge. Last year it was actually a net negative, and yet the Bloomberg Commodity Index went up anyway because enough other markets were positive. But now cattle's, just like the grains, look to me like they're ready to take food prices up. And it looks like it could be a sort of thing where there's a void, where the initial up leg could be, again, the whoosh effect, where there's just simply not enough for sale. And there's a vacuum, and they could rally sharply in the first leg. And so cattle looks to me like it's freshly broken out upside. Not that it can't have a $2 pullback here or there, but it looks like an emergent bull.
Yeah. Well, it really looks good, and I'm looking right now at my ownership of cow. COW is a symbol. It's an ETF that is, I guess, priced off of the futures, off the live cattle futures, and it's up very nicely in the few trading days. And then I went out and bought some call options on cow, and they're up doing much better even than that. A lot better, in fact, because of the leverage effect. You also, with a couple of minutes left here yet, Michael, I know that Moo is one that you've looked at. What does Moo involve?
Moo is the agricultural industry stocks, not the commodities themselves. DBA is the ETF for the actual food commodities. It includes the meats, the grains, and so forth. But Moo is the companies, like Monsanto, Syngenta, Agrium, Potash, the fertilizer companies as well, even Deere, John Deere. And so they should benefit from a commodity food price rise. And it's technically behaving as if it will. And I think if you have to be in the stock market, I would be in commodity-related, not oil at this point. I think that you got your gains last year. I wouldn't be joining in that thing, oil stocks, that is. But food-related commodity companies that help grow the commodity, help harvest the crop, like John Deere tractors, and so forth. That's probably going to rise even if the market goes down, but certainly behave better than the broad market.
Right.
So if you're an RIA looking to advise your clients on, they got to be in stock market. I suggest you take a look around in at the Moo ETF and the stocks within it.
All right.
As a place to be long stocks.